Welcome back. My name is Arya, and I don't waste your time. So let's get straight into it. Ladies and gentlemen, I never usually ask you guys to stick all the way through and end up watching the video in its entirety. I do recommend you do that with this one. I think it's probably going to be my most educational video I'm probably going to make in a while. There's a very high likelihood you're going to come out of this video learning something new. So just want to put that out there. With that being said, the main topic of today's video is how cash flows, free cash flows in particular, are actually lying to you, or I guess deceptive. And we'll dive deeper into it later on in the video, but to kind of give you the surface level of it, depending on the investment cycle that a business is in, things could be skewed in the short term, but then within a couple of years, and Amazon is the perfect example of this, within a couple of years, all of a sudden you got outsized free cash flow generation, and we'll dive into that. But to kind of set the stage and really start like super broad, I want to kind of help explain the two methods of accounting that we have in North America in particular, US and Canada, which is by GAAP standards, we have the accrual-based accounting and we have the cash basis of accounting. Now, this might sound complicated. Frankly, it's not that crazy, right? So the accrual-based version of accounting, this simply says that, for example, if you are a airline company, right, you might collect revenue for a plane ticket 6 months down the line, and accrual-based accounting simply says, based off the revenue recognition law, that you have to recognize that revenue, right? Recognize meaning you say that you've generated this revenue 6 months down the line when you actually provide that service to the person who purchased the plane ticket. Sure, you've collected the couple $100 for the plane ticket today because they bought it in advance, 6 months in advance, but you're not allowed to say that you generated that revenue until you provide the service that generates that revenue. I hope I'm making sense here. With cash-based accounting, it says we don't care when you're providing the service. That doesn't matter. It matters if they actually paid the money, they paid the revenue to you, right? You've collected the revenue for this service to be provided 6 months down the line. You've received that revenue and you put it in the bank. It's your money now. You could do whatever you want with it. That person purchased that ticket months and months in advance. Doesn't matter that when you're providing the service, you have hold over the revenue that person gave to you, right? With the cash-based accounting, it simply cares about the cash that came into the business and the cash that left the business. Doesn't necessarily matter when we're going to provide these services to our customers, right? And you can start to think, oh, okay, there's a lot of businesses that kind of have that aspect of what's called float. In essence, float is, and Buffett talks about this all the time, where you are able to collect funds up front for services to be provided later. I'm going to repeat that sentence. I think it's of the utmost importance. You're able to collect revenues up front for services to be provided later. So the fun thing that you end up doing there is you have all this money from thousands and thousands, oftentimes even millions of clients or millions of customers. You have all this money pooled up that you've collected for plane tickets or sports games that are months and months ahead, or whatever the case is, whatever product you are selling. You've collected all this money up front for an event that's way down the line. In the meantime, you could invest all this money back into the business, right? So let's take the airline example again, right? If you're an airline that you've collected all this revenue up front, you could reinvest that money into buying more and more planes or buying a new office building to better help, with the logistics of your entire operation and whatnot, right? You have all this money cash-based that it is now yours because they bought the plane tickets, and you could go and reinvest into the business and do whatever you want with it, right? So with this is why the cash-based version of accounting is oftentimes more important for investors, because you actually see what the money that the business actually has a hold of, right? Not necessarily have we actually provided the service and have we earned it, quote unquote, all that type of stuff, right? I went on a pretty big rant here, but I hope you're following, right? So we have these two different types of accounting in North America, and the cash-based version of accounting is oftentimes for investors more important. That's the gist of what I said, everything here. So you guys might be sitting there thinking, Arya, great, free cash flow and cash flow as a whole, the cash-based version of accounting, it seems from an investor perspective, that's the better way of looking at things. That's the raw profit that the business actually has generated in any given accounting period. Arya, makes sense, I'm following. But how is free cash flow lying to us? Arya, I mean, it seems like, if anything, it's the other way around. Net income and the accrual-based version of accounting with EPS and all that type of stuff, if anything, that is kind of lying to us because the cash came into the business, they're providing the service way later on, right? So here's the part where it gets a little bit fuzzy. And I've pulled up the equation for free cash flow just so everybody's on the same page here. I'm sure many of you guys already know this, but for those of you who didn't know, free cash flow is derived by, and stay with me here, cash from operations minus capital expenditures. And we'll dive into what cash from operations is in a second here. But capital expenditures, this is the aforementioned investments back into the business. So again, going back to the airline example, this is if they were to buy a new plane, right? They're investing back into the business. It's a hard asset that they're going to be able to keep for 10, 20, 30 years. What the durable life of that asset, that hard asset, they're able to keep it for a very long time. That's considered a capital expenditure for the business, a very long-term asset for the business. Another example could be a office building, right? When you buy an office building, that's going to exist into the business for a very, very long time. Trucks for the business, or even all the way down to like computers or like office shares, right? These are all considered capital expenditures for the business. These are things, assets that is owned by the business for a very long period of time until they inevitably break down and you need to replace them and whatnot. And so the difference of cash from operations and capital expenditures, that is your free cash flow. Or yeah, what's cash from operations? I pulled up Microsoft here, and I'll move this to the right so you guys could see. But if we go down here, cash flow statements and the operating activities, we'll see what are some items that are impacting the cash from operations line all the way at the bottom here. So the way we do a cash flow statement, you would drag down your net income number, and then it looks a little bit weird, but you would add back depreciation and amortization because they're not cash-based expenses for the business. This is something you've purchased maybe 10 years ago. You're depreciating it down over time and whatnot. A couple other things, amortization of goodwill and intangible assets. If you have like a brand, if you have a patent, these are intangibles of the business. That these are assets that the business owns. Obviously, the patent is worth something, but it's intangible. It's not like a truck that you could measure and kind of look at the value over time and whatnot, right? So a couple other items here. We have stock-based compensation that we add back. This would be if the business, so in this case Microsoft, instead of paying their employees in cash, which is what like basically everybody gets paid in, they would be paying them in shares of the actual business, right? Like you and me, we buy the Microsoft shares. Microsoft is actually able to issue shares to their employees instead of paying them in cash and whatnot. A couple other things, we have just other operating activities, accounts receivable, inventories, changes in inventories, accounts payable, unearned revenue. So this is the thing I mentioned of like 6 months down the line, the airplane company and whatnot. So a couple other things, taxes and whatnot. And so just general business operating activities, right? Like if I were to sum it up, it's quite a accurate title in that sense that these are the operating activities of the business. These are just paying the employees. You got accounts receivable, accounts payable. You have the depreciation of assets around your business and whatnot. And then of course you have your taxes, changes in income tax and whatnot. And that is your cash from operations, right? So the cash that you have after you've done your general business operations. And then in order to derive free cash flow, I'm going to remind you, we take this number that we just got at the bottom here, $118 billion. And then if we go into the investing activities, one of the top lines here is this one right here, capital expenditure. So capital expenditures, again, I'm going to remind you, this is the investments into, for example, office buildings, airlines. In the case of Microsoft, they invest a lot into IT infrastructure, that type of stuff. Investments into hard assets back into the business. That's capital expenditures. So we take this number here all the way to the bottom. I think it's just shy of 120 billion. And then we take roughly 45 billions of capital expenditure. That means that we end up with free cash flow of $74 billion. And another way I could kind of visualize this for you is we could take these two numbers. We could take the CapEx, we could take the operating profits. It goes into the negative here, but as you can see, kind of like the orange and the yellow, they're equal to the blue bar, right? Because these two added together equals the cash from operations bar and whatnot, right? So I hope I've kind of gone on for 10 minutes here, but I hope I've kind of given you a decent introduction into cash-based accounting, and then on top of that, the difference between operating cash flow and free cash flow. This is the meat of it. This is like the massive insights into why free cash flows are lying to you. So as you could kind of see with this as well, the amount of capital expenditure that Microsoft in particular has done over the years, it has continued to grow as a percentage of the operating cash flow or the cash from operations. So over time, this yellow bar is becoming bigger and bigger, and it's growing actually faster than the cash from operations over here in blue, right? So you could see that since the 2015 period over here, the cash from operations for Microsoft has grown at roughly 17%, but the amount of capital expenditure they do per year has grown at roughly 25% per year, right? So over time, the yellow bar is making up a bigger and bigger portion of the blue bar. And I tweeted about this roughly a month ago, and I talked about this. I said capital expenditures as a percentage of operating cash flow has continued to climb over the past 20 years for Microsoft. This shows that over time, Microsoft in particular is investing more and more back into the business, and it requires a lot more assets and long-term assets to continually be able to run this business, as evidenced by the capex to percentage to operating cash flow percentage chart over here. And this goes all the way back to 2004. So you got 20 years of historical data over on Finchat, and you can see that back in 2004 or 2005, it was less than 10%, right? Like barely anything meaningful. This is very capital light. But over time, you've seen it climb, and this is partly due to the rise in cloud computing, Microsoft having to dump a lot of money into the cloud computing division of their business, and partly just due to Microsoft becoming more capex heavy in general, right? So over time, they've started to dump more and more capex into the business, and it sits at an all-time high of 36% today. And we could go back onto Finchat, and I could visualize this as well. So we've actually had a quarter. Microsoft reported between whenever I posted this, July 23rd, I think, yeah. So Microsoft reported, and actually it ticked up slightly, because if we go here, it was at 0.037, replacing a 0.31 quarter to a year ago period. So because of that reason, Microsoft has actually ticked up slightly for the 2024 fiscal year. So again, as you can see, there's a very clear trend to this, where Microsoft over time, and we could actually toggle on the average over the past 20 years. The average over the past 20 years, Microsoft was roughly in the midline here. About 20% of operating cash flow was being used towards capital expenditures. But as you could see, over time, it's grown to nearly 40% of the business. And is this worrisome? I mean, kind of, but not really. Like, if they're seeing a lot of different opportunities to reinvest back into the business via cloud computing and whatnot, I would probably be happy as an investor if that company was doing that. Particularly, and this is like one of the only times where I think it's actually appropriate to use these return metrics. When you look at the return on tangible assets, return on capital employed, return on invested capital, it's well above the cost of capital that Microsoft would have, roughly about 10%, right? So, for example, ROIC and ROCE is roughly about 30%. And this shows that these investments that Microsoft is making, these capital expenditures that Microsoft is doing back into the business, they're yielding them a very high return. For every dollar they invest into CapEx, they're able to get roughly 30 cents of that back within a year. And then obviously now they have this asset that is continuing to produce profits for them on a going forward basis, right? So it's 30 cents per year. And so you have roughly a payback period of about 3 and a little bit years, right? Unless it compounds, but I don't know. Anyways, you guys get the point. And in my original Twitter thread that I talked about this, I kind of talked about, like, is this really something worrisome? Is this something to look out for as an investor? Is this one of the early innings of Microsoft's business model changing? The business model is changing, but I wouldn't argue that it's necessarily a bad thing, right? And I say this naturally suppresses the free cash flow metric by quite a large margin. This isn't to say that we should disregard CapEx. It's crucial for growth, but it's essential to understand the context relative to Microsoft's historical CapEx levels. The past few years have seen abnormally high expenditures, partly due to the last 7 to 10 years of the cloud boom and Microsoft's cloud footprint build-out. CapEx as a percentage of operating cash flow has skyrocketed to, at the time it was 36%, it's closer to 40 now, in the past 12 to 24 months. And so Microsoft as a cloud hyperscaler meaning like it's one of the big three cloud computing companies among their, alongside Amazon and Google Cloud Platform. As a cloud hyperscaler, they need to keep reinvesting back into the business with the leading edge NVIDIA chips or the leading edge data center chips, whatever it is at the time. They need to keep doing all this in order to stay competitive and in order to lead at the cutting edge of the cloud computing world, right? So they need to do a good amount of CapEx. And I'm not denying that. That's evidenced by, even if you look back between like the 2018 to 2022 period, they were in the high 20s percentage range, right? Like it was like 27. You have one off year, 2020, which of course I think we give them an excuse there, right? So they were consistently reinvesting a lot back into the business in terms of capex into the data center business, right? I'm not denying that they should 100% do that. They're making high return on capital employed on those investments. I'm not denying that at all. But you would notice that in 2023 and 2024, it's kind of skyrocketed out of control just a tad bit, right? Like, and this is partly due to, I think, the AI boom. I think Microsoft and honestly all these different big tech companies, they've started dumping excessively into the AI companies, and I'm not sure that'll be sustainable. I really don't know. I think maybe, NVIDIA with the way it's looking now, I'm sure they've carved out a decent moat around them. They need to probably keep buying these NVIDIA chips in order to stay competitive and draw the most amount of revenue towards their businesses. But this is abnormally high even for Microsoft that is already pretty CapEx heavy, at least on this side of the business, right? So just something to consider. I don't know what this necessarily means. I'm not going to sit here and pretend and to be like a know-it-all in front of you, but just something to note. This is abnormally high, especially way above the averages, even looking back to the Steve Ballmer era, right? Like prior to give or take 2014, this is a lot of CapEx. And so the reason I really did this video and to kind of like wrap everything up at the end of it here is you guys know the valuation spreadsheet that I like to include in all my videos. Long story short, we are taking the current valuation of the business, dividing it by how fast we expect it to grow, and then we put it all next to each other. You guys know I use this everywhere, right? So the reason why I did this video is to eventually come here and tell you this. When you look at this spreadsheet, it's a little bit misleading because not every single company on this list here is optimized for cash flow. For example, another business that is not optimized for cash flows, again, partly due to the fact that they're extremely capex heavy, is Taiwan Semiconductor Manufacturing, which they buy like massive multi-$100 million lithography machines, and they're in and out of the investment cycle, and it's completely random, right? Like these things happen with TSM, right? Or even for the case of ASML has like very random sporadic cash flows, right? Like it's not guaranteed that they're going to have like a continuous chart up into the right, like for example Visa or MasterCard, right? Like these things happen. These are real businesses. They have cash flow timings that are just completely random, right? Or they go into investment cycles and whatnot. For example, Microsoft's currently, right? So when I put this chart, or when I put this spreadsheet in front of you guys, you need to take it with a grain of salt because not everything is optimized for free cash flows. In the case of Microsoft, if we go over to Finchat over here, and we're actually able to see the analyst estimates for example, free cash flow. And so simply bringing up the free cash flow chart here and then drawing it forward by one. I'm going to move my camera so you guys can see it better. You can see it's like roughly 77-ish billion. And I've put in the next 12 months, that's what NTM stands for, I put 85 billion. Why did I do that? That seems a little bit optimistic. And this is me kind of adjusting. And of course, you probably shouldn't do this. You shouldn't massage the numbers to kind of fit your, whether you should buy or whether you should sell and whatnot. But just to kind of make it like a little bit more accurate to see how it would trade, I've kind of massaged it. I just told you not to do it. But anyways, I've kind of played with the number. I've toyed it a little bit for it to be only like 30% of operating cash flow was capital expenditures, right? And in the case of TSM, which I just mentioned a second ago, this is like an even more egregious example of me massaging the numbers. So if we bring up TSM's US numbers here, and then we pull up free cash flow, move it forward by 1 year. Oh, this is in Taiwanese dollars, USD. There we go. So yeah. Oh, okay. Never mind. I take that back. So actually, the forward free cash flow is $20 billion. But okay, I'll give you another example. Paycom, you guys know, Paycom is a company in my portfolio, roughly, I think a 6-7% stake in the business. This one is, this one's massively off, right? Like if I drag this forward, this is $300 million of free cash flow. If you look at my spreadsheet over here, I put 400. Arya, why did you put 400? That's like a 33% increase over the expected forward free cash flow that Paycom is going to produce, right? And there's two reasons to this one. It's a smaller stock. It's only like it's a sub $10 billion market cap business. So there's not that many analysts covering this company to begin with. That's why I don't really rely on the forward projections for this company. So that's reason number one. But reason number two, you might have guessed it, they're doing excessive amounts of CapEx into the business, more excessive than what they typically do. And I could show that to you by simply searching up CapEx to operating cash flow. And we could take a look at this. You can see that it's elevated levels of CapEx 40% of operating cash flow for a software business, right? We could pull up, for example, CRM, which or you know what? Let's go with Workday, because Workday, they're also an HCM company, and I've actually not searched this up, but if I were to take a guess, they're doing way less CapEx, right? Roughly half or even less. So we could take a look at this. So for Paycom, it was 40%. For Workday, it's a 75% reduction compared to Paycom. That means that Paycom, as a percentage of their operating cash flow, is doing 4 times more investments back into the business than Workday, a comparable business. Just take my word for it, right? So to kind of summarize the entire video, depending on the investment cycle that the business is in currently, depending on how much they are investing back in the business, which you check by looking at the aforementioned CapEx to operating cash flow line, when you look at that and you could look at the trend of that over time, you'll be able to decide whether this is elevated compared to historicals, or in the case of something like Paycom, this is just elevated for a software business. As you could see, when you compare Paycom to its peers, for example, Workday, or you could honestly pick any other enterprise or mid-market software business, you'd be able to immediately see, oh, they're doing excessive amounts of CapEx compared to other comparable businesses. And so with that, again, I'm going to warn you against massaging the numbers and kind of changing it around, but take it with a grain of salt. That is something that you acknowledge. This business is not optimized for free cash flows. With that being said, I hope you learned something. I've been using Finchat the entirety of this video. You guys know I've been using Finchat from before I was even affiliated with them in any particular way. This is a website that I truly love. There's only one kind of like sponsorship or affiliation that I have on this channel. It's Finchat. I've denied other websites, I've denied other brokerages, all that type of stuff. This is really the only one. It's because I actually use it, I actually enjoy using it. I use it almost daily, like usually most days. There's something I'm curious about and I go through it. It's very comprehensive. I've done a video on Uber, which we went through. We did basically everything on Finchat on that video. Using the link in the description down below, I do make commissions off of that. You could just sign up for a free account with no credit cards. You don't have to input any payment information. It would help the channel out. Just simply go down there, top link in the description, sign up using your Google account. You don't have to put any other information into it. And honestly, it's a damn good software. With that being said, if you like the fact that I don't waste your time, I'm going to continue to post high quality videos just like this one. So you should hit the subscribe button. And you can always go back on that decision if you end up not liking the videos, but I highly doubt that. Thank you for watching and have a great day.